Welcome to OK Computer. I am Dan Nathan. I am joined, as always, by Deirdre Bosa. She is CNBC's TechCheck host. Deirdre, welcome back.
Hello, I'm glad to be here. Kicking off earnings season soon enough.
Oh, man. I mean, listen, you are going to be in heavy, heavy demand. I think I'm going to be seeing you every night on CNBC's Fast Money and throughout the day reporting on all the tech earnings. This is what I get actually most excited about. Last week was like bank earnings. How boring, right? So this is going to be
into the good stuff.
This is going to be the good
growth,
stuff.
Profitability.
Oh, man, I know. And so, listen, we have a lot to cover today. There's a bunch of stuff in the private markets and the public markets. I also had a great conversation with my friend Joe Marchese. He's the build partner over at Human Ventures, and also my other friend, Packy McCormick, who is the managing partner at Not Boring. We had this wide-ranging conversation on how they're thinking of AI and these large language models, and how they're also kind of like the stuff that they're seeing as, investors, but they're also thinking about it a little bit from a build standpoint. So stick around for that. But Dee, let's hit this one story. I thought this was kind of interesting in the information. It was talking about Instacart. This is a company that you've reported on for years. And it was, what I found was interesting is like they were quoting some secondary market price action, okay, or at least interest in Instacart shares. They were talking about how there's been very little interest on the buy side. I think it was last valued maybe in 2021 at $39 billion. I think there are some private market transactions or secondary market transactions that have happened maybe around 10 billion or so, but they're really talking about the supply demand dynamic, where I think they quoted maybe one broker where 88% of the interest was on the buy side or something like that. Talk to me a little bit. Is this a sea change for you? Some of the things that you're hearing in a way, because this could be, the lag effect that you and I have talked a lot about. When you look at a NASDAQ that's up 20%, and you look at a lot of the hardest hit stocks from their highs in 2021 are up 80%, 90%, some of them. So to me, is that what the bargain hunting is coming from, this just sort of lag effect in the private markets?
Instacart is such an interesting case because it's one of the oldest unicorns around. I mean, it should have gone public in the era of DoorDash and Airbnb. It missed that window. It had a CEO transition. The founder stepped back. So maybe this is an indication that we could be getting closer to that IPO. Don't hold your breath, because we've been here before. They've been on the precipice for it to not happen. But I'm looking forward to this one because I have a feeling it's going to be a different business model than the likes of some of the other gig economy companies like Uber, Lyft, DoorDash, because it's always had this lucrative advertising business. I don't know how lucrative, but you imagine the margins are better than 3P delivery. So it'll be interesting. The idea that maybe it's fetching more in the secondary market, as you said, Dan, that makes a lot of sense because we've seen stocks run back up in the public space over the last few months. But Instacart, remember, has been really proactive in terms of valuing itself. That internal valuation called a 409A brought it down when the market was coming down and is bringing it back up. So this makes sense. And if the markets remain on track, if they don't become too volatile once again, the big if as we head into earnings season, maybe the next few months is right for this company to finally go public.
Yeah, it's interesting. I just, listen, 40 billion to 10 billion. When you think about those sorts of numbers, we saw plenty of brand named, publicly traded companies that had that sort of discount at their lows late last year. So if you still think the stock in the public or the private market is trading anywhere near that last trade, you're going to get in there and you're going to try to find a valuation that you think is going to look very cheap by the time they start filing IPO papers.
Yeah, I think that's exactly right. And the thing is, we don't know how much it's worth. If you think that Uber can be a $60-80 billion company and we know how much money it's losing, I mean, Instacart is reportedly actually profitable, going back to the advertising, the enterprise business that it has. So maybe it can fetch that much again. But I think that's a big question, right? For a lot of the tech companies we talk about, Dan, can they ever get back to those peak valuations? And we don't know for Instacart until we see those actual financials.
Well, I think for some people who recall, who are as old as me, that the NASDAQ took 14 years to get back to its bubble highs from 2000. And so obviously there was, dozens, if not hundreds of stocks that never made it to the NASDAQ new highs in 2014 or 2015. But here's one. This is a company that we're still talk about a lot, and it was around for the internet bubble of the turn of the century. This is Netflix, and this is interesting. We are recording this Tuesday into the close. By the time you're listening to this, Netflix will have already reported their Q1 earnings. But here's a story that just crosses my email box from the Wall Street Journal. Debo, you're gonna love this. Netflix winds down DVD rental business. So in September, they're going to ship out their last red envelope. And really, it's a pretty amazing bookend because I think you wanted to talk about, you were tuning in for some like live reunion on Netflix from one of your favorite reality shows. And you got the Heisman on that. What happened with this whole thing?
Okay, I'll admit it. I did watch Love is Blind. I love it. I can't hide it. I was waiting. I don't know why I needed this. I mean, I did not need a live reunion special at all. I don't think anyone needed it. Nobody asked for it. This is not live sports, but Netflix decided to do it. Maybe as an experiment to show that they can go into live programming. Maybe that's a predecessor for something else it wants to do in live TV. I mean, it's the last holdout, right? In terms of grabbing onto live sports like Apple and Amazon and Google are all doing. But it was such a spectacular disaster for me, yes, because I don't know if I'd say eagerly, but okay, fine. I was anticipating it. But this was supposed to be the experiment. It was only about 5 weeks ago that it successfully rolled out a live event with Chris Rock. It couldn't do it the second time in a row. And it's maybe created some anxiety over the idea of, can Netflix do it? How technologically advanced is it? I mean, it was the first streaming platform. They're getting rid of the red envelopes, which, by the way, the most surprising thing about that was that they were still shipping the red envelopes. But aside from that, is the technology there? Can Netflix be a leader in the next era of streaming, which we're starting to figure out what that is right now? And it feels like that's going to involve some kind of live element.
Yeah, what's interesting about that is like when you think about all these companies just mentioned, all the big platform companies have been bidding for the sports rights, and we know how important that is. And we saw all the unbundling. So all the big networks, right? They started their streamers, they rolled them out, they were independent. Now we're starting to see a rebundling of them. The Max and the Discovery sort of deal. So it's going to be interesting as we see like consolidation again, but really more on the streaming. There'll be different rights, right? Like for a lot of live programming, and I think, to your point about Netflix trying to compete, let's say, with an Amazon or an Apple in live sports, as opposed to broadcasting a live, maybe ticketed sort of situation with like a Chris Rock, at the Apollo or something like that. That seems to be very much in their wheelhouse. And you know what? Like, you have been covering tech for a long time. And, me as just kind of a market participant and looking at these kind of, some of these attempts and the failures and everything like that, they're really short-lived, right? Like, people are not going to remember this in a couple weeks. Like when they have one really successful launch, right? And then they have another, then it's all behind them.
You're so right, because I remember when Amazon did its first Thursday Night Football, everyone complained about it. It was glitchy, it lagged, and no one's talking about that anymore. I mean, it's still interesting when my husband is trying to figure out where to watch Thursday Night Football and I tell him it's Amazon, and that still kind of blows his mind. But you're right. I mean, he just goes there and he gets it and you don't notice any issues. So I think you're right. And I think tonight, where where Netflix is going to set itself apart, which it has continued to do, is that profitability element, right? When all of its rivals are still losing so much money, the fact that it's expected to bring in more than $1 billion in net income, that really is, saying something, has said something over the last year, but it's going to face more competition as some of these other streaming platforms get that profitability piece more in place.
That's right. And this is one that like I find kind of interesting. At some point, we're going to see a lot of M&A. I think when people feel like the NASDAQ bottom, the economy is probably on better footing. It rarely happens at the bottom where you see like large strategic sort of M&A. But I always thought like Netflix would do very well by like buying a Spotify, for instance. They have, like 10 percentage points higher in gross margins, and think about how you could just streamline a lot of costs. And to your point about profitability, where, Netflix is doing, over $1 billion, Spotify's still losing, what I mean, on a GAAP basis here. And so I wonder if we're going to start seeing deals like that, which would make a whole heck of a lot of sense, where you have this video streaming platform, you have this audio streaming platform. They're both best of breed. They both want to do more engaged sort of activities. Spotify obviously pushed very hard into podcasting, and they wanted to do a lot of live podcasting, video podcasting, that sort of stuff. That might be just a really good combination that would make a whole heck of a lot of sense to me before Netflix goes on another spending binge. We know what they did over the last 15 years with original content, which really weighed on profitability. Now they have that scale. I think it would almost make sense to do something that's kind of more in their wheelhouse.
That's interesting. Instead of spending on content, which I think investors are getting a little bit sick of because there's so much that is unwatchable, Don't include Love is Blind in that. Maybe they spend to acquire something that they can put into their portfolio. And I mean, that's interesting because Netflix, I don't think, would have the same kind of regulatory pressures stopping a deal like that versus an Amazon or an Apple or Google that might want that property too, a Spotify.
Yeah, I think in some ways you would probably, if you're regulators, you'd almost regulate it. It's not one of those situations that I think would, listen, it really is about consumer protection and pricing power, that sort of thing. And I think that, you'd much rather see a stronger Spotify and Netflix combination to kind of combat an Amazon that uses the profitability that you and I talked about last week from AWS to finance all these other money losing businesses, right? It makes them very hard to compete with if you think about that. And then you think of an Apple with a 2 billion installed base of iOS devices. They can do whatever the heck they want, whenever they want.
The other question, though, is would investors, I mean, Netflix is kind of the advantage it has over its rivals is that profitability. If it acquires something that is losing money, do investors not like that? Because in this market environment, I think still investors want to see that profitability over perhaps revenue growth. And this earnings season, revenue growth isn't going to be anything to write home about.
Yeah, no doubt about it. I mean, listen, I think that at some point though, like the Netflix, especially as Reed Hastings takes a step back here and they kind of change some of their kind of content strategy. I think that, to your point, a lot of users are feeling a bit, overwhelmed by the level of content. Here's a good example. My wife and I sat down to watch Hustle. I was watching it for the second time. That was the Adam Sandler movie. Amazing movie. Okay. And then all of a sudden I start getting shown an Adam Sandler like murder mystery thing. And we just let it roll and we watched it. It was horrible. Right. So you have these like two
Come on,
opposing.
don't say that about Adam Sandler and Jennifer Aniston.
Yeah, but you know what I'm saying? You have these two opposing experiences where, it very much felt like, a Netflix movie on both sides, right? Like one amazing piece of content, but for every amazing piece of content, there's probably 5 really bad ones. And so for me, if they want more of my attention, then one app that, I'm spending time on music on Spotify, I'm spending time on podcasts there, but I'm also doing a lot of video. And then there could be, a lot of engagement that is kind of, just in between those content users and all that sort of stuff. So to me, I would find it very interesting, but I'm not a shareholder in either of them. All right, here's one. I saw you on CNBC earlier on TechCheck reporting on a double upgrade of Nvidia. This is the last holdout. This guy over at HSBC had a sell rating, and his previous target on the stock was 175. The stock's trading at 275 as we speak. Now he's got the highest price target on the street of $355. And I think it's important to remember this is what, a $650 billion market cap company. This is very likely to be the next company in the $1 trillion club as far as market cap concerns. It's actually 682, and it's making a new 52-week high today. Thoughts on that? Because I thought you had a good hit on CNBC.
I mean, a double upgrade. What an upgrade. We haven't seen one of those in a while, where he was the only sell rating on the street, frankly, at HSBC. He said that he was shocked by NVIDIA's pricing power for AI chips, which, let's just say, the market has not been shocked. This has been well telegraphed. This is a stock that's up 90% year to date, 140% since its October low. And that's really been the whole story. So he's been kind of late to the game, but there's another headline this morning involving AI chips that I thought was actually even more interesting. And that came from The Information. And it was a report that Microsoft is working on its own in-house AI chips, codenamed Athena. And to me, this feels like, a risk to that incredible bull story to NVIDIA. Yes, it dominates the market, and it's really the only game in town when it comes to those advanced AI chips that you need to process the huge amounts of data that these large language models are being used for. It's not just Microsoft working on this. It's Alphabet, Google, it's Meta, it's Apple. These companies know that AI is the next big platform shift. It's happening in front of their eyes, in front of our eyes. So they're working on these chips, and they're not there yet. I think that everyone may agree with that, but the fact that they're working on it presents maybe a threat to that bull case of NVIDIA in addition to that valuation.
Yeah, and I guess the point, I think that's like a really, you've seen this time and time again, right? You saw it with Apple as they were just trying to vertically integrate as they were just owning the high-end smartphone market, right? And they wanted to dictate the sort of capabilities that were in a lot of the chips and that sort of thing. And every time you'd hear those stories or see those stories, you'd see Qualcomm sell off, or you'd see, Samsung take a hit overnight in Korea, that sort of thing, or whatever. But they were always like way away, right? It takes a long time to develop this stuff. And I don't think anyone who's been following tech for the last 25 years thinks that Microsoft has any real core competency when it comes to doing that, right?
Well, okay, let me provide the opposite case though. The Apple M1 chips have just been a real sea change. I mean, that's been for their laptop line, their MacBooks and so on, but that really has hurt Intel and displaced them in that ecosystem. So it's almost like I don't know that anyone thought that was possible. And we woke up one morning and Apple had done it, and that has changed their proposition, their supply chain, the chip space over the last few years. So it may still remain very far out. And you're right. Maybe no one thinks that Microsoft is going to be able to create something that can really genuinely compete with what Nvidia spends its entire lifetime on. But it's not one to be overlooked. And I think that what Apple's done with the M1 or the M series of silicon is maybe a warning for that. And maybe Microsoft doesn't do it, but maybe Google does.
Yeah, no doubt. All right. You were reporting on this yesterday. This was Monday. There was a story, I think it was in the New York Times. They were talking about how Samsung, for their smartphones, were considering bouncing Google's search in place of Bing. So what was your reporting? What was some of your thoughts on this? Because again, this is not the sort of thing that can just turn on overnight. When you think of Samsung market share, it's not meaningful here in the US, and it almost feels like this would be more of a psychological hit. I don't know if anybody out there in the mobile space that has meaningful market share wants to attach their wagons to Microsoft for a whole host of reasons, because at some point all of these other players are going to catch up, right, to the OpenAI and whatever they think advantage that Bing has right now with their partnership. So to me, it just seems like a catchy headline, and there's definitely been, as you and I have been talking about for months, some massive market cap shifts, right? Like Google was down 3.5% on that headline. I mean, when you think about that, that's like $50 billion or maybe more in market cap or so. Investors are still, I guess, to the word that you use, maybe, there's still a little bit of panic around all these headlines.
There is. And is that overblown or not? I mean, yeah, 3.5% down on that one headline reminds me of a few months ago when Google botched its Bard, what do you call it? It's Bard debut. Yeah, the launch, and they had all these issues and they had some factual inaccuracies in it. And I think that week Google was down something like 8%. And Microsoft was up, and you thought, what is happening here? We look at that a few months on, and actually both those stocks are just neck and neck year to date. Hasn't really mattered. And that's because, to your point, Dan, Google has been working on this for a very, very long time. They are still thought of as the leaders in artificial intelligence. You see Sundar Pichai give an interview on 60 Minutes, and he gives the impression that they're moving cautiously and responsibly. They have the power, the intelligence, the processing to do all the same things that OpenAI, ChatGPT, Microsoft, Bing are doing, but they're taking a more careful stance. But at the same time, there's cracks now. Can you imagine, Dan? I mean, there's cracks in the search business, which has just been so unassailable for so many years and been, the best business model in the history of business models. And now there's cracks showing. And I think that's what that Samsung story did, which is, in that way, I don't think that it was necessarily overblown, because Samsung, while the revenue that Google search brings in, or Google pays, whatever it is, to Samsung, the $3 billion that was cited in that New York Times, that's a small amount, relatively small amount. But Samsung's phones run on the Android system. So it's a pretty big deal that they were even considering this. And again, it's just maybe the first crack. There's a reason that Google spends so much money, as much as $20 billion to Apple, to keep that coveted spot. So are we starting to see the beginnings of this empire cracking, maybe declining in the longer run?
Well, I mean, listen, the clearest example of that is that in 2015, Google had nearly 79% gross margins. This year, they're expected to have 59% gross margins. And so when you think of the premium valuation that this stock traded at for a long time that was growing at, 20% a year, both earnings and sales with, nearly 80% gross margins. It was trading well above a market multiple. And now when you think about it, it's trading at about 20 times this year, 17's next. And, I always say this is kind of more, fast money sort of take here is like, listen, when you're looking at that out year and people say, well, it's cheap, Meta was in the same situation in 2021. People were looking at the out year saying how cheap it was, and they didn't see the ground moving below their feet for all intents and purposes. And so that's what I would be really focused on as it relates to Google. And if you're telling me that if all of a sudden now the cracks in the armor are becoming very clear, then this is where you really want to have your antennas up. You don't want to be, sleeping, like whistling past the graveyard here, assuming that they're going to be able to maintain share or take back some share and then improve their margins.
Right. And behind that whole idea is that it's not going to end with a bang, but with a whimper, right? And all of these little cracks along the way are going to erode that dominance that Google has held. At the same time, Google, I think, is pouring so much money, so much investment, and so much of its focus into cloud because maybe that's where the margins are going to come from in the future. And it's been reducing, its cash burn or its losses in that segment. So it is one of the three big hyperscalers. Maybe that's where the growth will come from and potential future profitability.
Yeah, no doubt about it. So crossing the tape right here is that Fox is settling with Dominion. So Dominion was the maker of these kind of voting machines, and they were suing Fox for pushing, what they said was false narratives and for defamation. They were suing them for $1.6 billion. I'm just curious, as a journalist, not opining on the settlement or the case or anything like that, what was your thought? You're somebody, you spend a lot of time on air. You cross your T's, you dot your I's. You go on air and you report on stuff, and every once in a while, I'm sure you get things wrong and you correct it and all that sort of stuff. What was your thought? I mean, because this is really a First Amendment sort of situation. If let's say Fox had lost this case, and again, not opining on the case itself, did you have any thoughts about this, or like some of your colleagues at CNBC or other reporters that you have? Like, was this an important event for you all?
As a journalist, yes. I don't think we covered it to the same extent that other networks might have. I thought Jim Cramer had some good comments this morning. He kind of came out hard. He said that he's been in the business for, decades, and he's never seen such egregious sort of playing fast and loose with the facts. So it's a big moment, I think, for the media industry, certainly. And you do have to wonder about the processes that were in place to lead to something like this happening.
Yeah, and I guess the point that I'm trying to kind of get at is like, okay, so let's say Fox had won the suit, right? And then maybe they just felt emboldened to continue to do what they were doing, or whether you agree with the politics of it or not. Let's say Dominion had won, and like, does that put almost every journalist on their heels a little bit and really, being very, very guarded? And I think the main story here is that, Fox in the evening is not news, right? But it is command a huge audience, and so if you're pushing misinformation, it's not as you're doing it as news. But I don't know. I find it very interesting. I was kind of hoping to see what a jury might have come up with in this case. The facts, because a lot of us have already seen a lot of the facts. We already saw what a lot of the Fox hosts were saying, behind the scenes, and so I don't know. I find it kind of interesting. I'm kind of bummed that the thing settled.
Yeah, in this era, though, it's more important than ever. And I agree with you. I wish that we could have seen this sort of go all the way through and a jury decide on this. But the news industry is in such a difficult position. There's so much misinformation out there. We're going to be heading into another election that this stuff is so crucial. And yes, mistakes are going to be made, but it's really important to correct them as soon as and sort of face the music. And so the fact that this had to wind through the legal system is so interesting, and it will have implications for the media industry for years to come.
Yeah, no doubt.
I'm looking at the headlines now myself.
All right, we can't get out of here until we hit Tesla here. So I thought Tesla reports tomorrow after the close, and it's interesting. The stock is up a lot. It was traded as low as $100 this year, and it closed today at $184. 4. It's down about 15% from its recent highs over the last couple of months. In the last couple of months, I think it was interesting. They had that AI day, and I think a lot of investors were kind of excited about it, but then nothing really came out of it. The stock sold off. And then into quarter end, the stock ripped for excitement about delivery numbers, which kind of came in a little bit below consensus. And so when you think about all those price cuts that have gone on over the last few months, I mean, people are kind of worried about the margins here. And margins are expected to be down a few percentage points from last year. I think it was 25.5% or so, expected to be 22. Some saying with all of these price cuts, and they just instituted another one in the last week, that's going to be really hard to kind of achieve 22%. And the other thing is I found this kind of interesting article, a day before they report in the Wall Street Journal. Tesla faces a tougher road ahead in China. They're talking about all the competition. They're talking about losing market share. They're talking about some of the local manufacturers that are not participating in these price wars. So they want to kind of maintain their margins or so. Thoughts on this? Because to me, listen, I think anyone who listens to this podcast, what I think about Tesla. I've been short Tesla. I'm still short Tesla. I'll be short into their number. I think that they're going to be hard pressed to kind of hit a 20% gross margin number, given all the competition and all the downward pressure on margins. But the last point is like none of the current estimates assume that the global economy or the U.S. economy is going to be weak, and maybe they don't find this to be particularly, a good environment to sell EVs. The last thing, and I know you spent a lot of time in Asia and reporting on U.S. companies doing business there, but also local companies doing business there. The geopolitical dust up that could occur or is occurring with U.S. and China, but what might happen with Taiwan, I would see U.S. consumers getting pretty nationalistic, in that scenario. So I actually think that the Tesla story in China could have peaked, and they just saw their market share go from 14 to 10%.
I think that China is really the story here. When we talk about competition in North America, I don't buy it. I don't think it's there. I think it's still a long way off. And if you're going to buy an EV, even in a softer economic backdrop, you're going to go for a Tesla. And, they're adjusting prices so that they continue to maintain that market share, that dominance. But China is such an interesting case because like we've talked about this before, Dan, that it's not Tesla versus Rivian versus Lucid here. They barely register. But when you're talking about a NIO and a BYD, those guys are already giants there. They're already selling to the Chinese public. And Tesla, I think, is going to have a harder road going forward. I don't know what it means. I don't know what consumers, if they wanted to own something Western built or Western headquartered. And that's, if you're a strong brand, that will go through. But it feels like we're seeing a sea change in China, whereas the Chinese EVs, you're right, it's almost nationalistic there as well. Maybe you do want to buy a Chinese manufactured electric vehicle.
Yeah, well, the other thing this article mentioned is that Elon Musk and Tesla were not at this big EV event that's in Shanghai. And a couple of years ago, I guess somebody was protesting, jumped up on a car, and it got a lot of attention in China. And I think that's pretty interesting. The other thing they mentioned is that all these other competitors, and there's dozens of them, they have new products coming out all the time. And so Tesla has not refreshed any of their cars since they launched in China. They certainly haven't. The Model S looks like the same as it did in 2011, 12. Here, it's a little slicker here and there. So that'll be an interesting one to watch. All right. Here, I got this one. So last one, and this is on Tesla. So I guess there's some disclosure. The regulators, you have to, you put data in about fatal crashes using, automated full self-driving, that sort of thing. And here's a question for you, because there was another crash, was a Model S, and I guess I'm just trying to get the number here. I guess there's been 66 of deaths in Tesla full self-driving. We know it's not really full self-driving, and that's since 2021. My question to you is this: is there any regulation? I know you cover the Ubers and the Lyfts very closely here. I find myself often getting into Teslas in New York City, in Uber or Lyft. And is there any? Do either one of those companies have any rules about the drivers not using FSD in the? I don't know if you know that or not. I don't know.
That's such a good question. I don't know. To my knowledge, no, but I wonder, especially it would be a very sensitive point for Uber, because remember, this was a few years ago, but it was developing its own autonomous driving fleet of vehicles. And there was that really tragic accident where there was someone at the wheel, but it was in self-driving mode, and it killed a pedestrian. So I don't know. It's a good question. I'll ask next time
All right, get Dara on the blower.
Get
I
Dara
want
on
to
the
hear.
phone.
I want to hear what he's got to say. All right, Debo, we covered a lot of ground here. I really appreciate you taking the time in your busy day. So thanks. I'm sure. I think I'm going to see you probably a little bit on the Fast Money. I'm heading out here right now.
Yeah,
All right.
perfect. And I'll see you in real life next week.
All right. Thanks so much. You guys stick around for my conversation with Joe Marchese of Human Ventures and Packy McCormick of Not Boring Capital.